72 US dollars for a single troy ounce of silver on the COMEX floor. You think that's the peak? Think again. This isn't just another speculative bubble or a playground for day traders. This is the sound of a global alarm bell. We are witnessing the price of survival. Right now, as you watch this, EV giants and green energy titans are silently stripping the world's last remaining reserves bare. Are we looking at a market correction or the beginning of a terminal supply shock? But to understand why that number, 72, is so critical, we need to look at what just happened at the very heart of the precious metals market, the COMEX exchange. Let's talk numbers, and I mean real hard data. In the most recent sessions for May and June contracts, we saw an opening price of exactly $72.72. On the surface, it looks like just another Tuesday on the trading floor. But look closer at the volatility range. We're seeing a tight, aggressive swing between $71.33 and $73.73. Now, why does this matter to you? In the world of high-stakes commodities, a range like this isn't just noise, it's a battlefield. When the price opened at $72.72, it signaled a psychological floor that the market is struggling to define. Every time the price dipped toward that 71.3 mark, the invisible hand pulled it right back up. This tells us one thing: liquidity is tightening, and the big players are fighting for every cent. For those of you who follow technical analysis, you know that the spread between these numbers represents more than just profit and loss. It represents the tension between paper silver and physical reality. On the COMEX, we aren't just trading shiny metal, we are trading futures, promises of delivery. And when the price stabilizes around $72 after such massive volatility, it's often the quiet before the storm. Reports are already indicating a slight uptick, a stabilization period that many analysts are calling the accumulation phase. But what are they accumulating? To the average person, a $2 fluctuation might not seem like much, but when you're moving thousands of troy ounces, that's a shift of millions of dollars in a single session. This $72 level is acting like a magnetic north for the market. The logic here is simple but profound. If the market were truly weak, we would have seen a breakdown below $70. Instead, we see the price hugging the 72 line like a lifeline. This suggests that the smart money is no longer waiting for a massive crash. They are accepting $72 as the new normal. But here's the twist. While the traders on the COMEX floor are staring at their screens, analyzing these three-digit decimal points, they might be missing the bigger picture. You see, the price on a screen in Chicago or New York is only half the story. The real pressure isn't coming from a trading algorithm. It's coming from the physical world, from factories, laboratories, and assembly lines that don't care about paper contracts. They need the metal, and they need it now. So, if the financial world is stabilizing at $72, why are the industrial giants acting like the world is running out of time? To answer that, we have to look away from the digital charts of the COMEX and toward the massive shift in global manufacturing. Because as we're about to see, silver has moved from being a luxury hedge to a strategic necessity in a way we've never seen before. And that leads us to the real driver behind this stabilization, the relentless hunger of the green revolution. Many people still labor under the illusion that silver is just the little brother of gold, a cheaper alternative for those who can't afford the yellow metal. But here's the cold, hard truth. Gold can sit in a vault for a century, doing absolutely nothing but looking pretty. Silver is out there in the world, in the trenches, powering the very fabric of our modern existence. Gold is for wealth, silver is for survival. Right now, gold might be resting in a safe, but silver is embedded in the solar panels that provide electricity to the entire world. It's in the circuit boards of the smartphone you're holding. It's the invisible nervous system of every electric vehicle on the road today. Let's talk about net zero. It's the buzzword of the decade. Every major government, from Washington to Brussels to Beijing, is racing towards a carbon-neutral future. But there's a massive problem they're not telling you. There is no green revolution without silver. It's the most electrically conductive metal on Earth. You can't just swap it out for something cheaper and expect the same results. In the solar industry alone, silver is the magic ingredient. It's used in the conductive paste that captures sunlight and turns it into moving electrons. As we ramp up solar installations to meet climate goals, the demand isn't just growing, it's exploding. We're seeing a vertical climb in industrial consumption. 10 years ago, the solar sector was a minor player in the silver market. Today, it's consuming nearly 15 to 20% of the total global supply annually. And that's just the beginning. Now, look at the driveway. The average internal combustion engine uses about 15 to 28 grams of silver. An EV? It needs double that. Why? Because an EV is essentially a giant computer on wheels. From the battery management systems to the autonomous driving sensors, silver is the silent hero making it all possible. As the world transitions from gasoline to lithium, the demand for silver is being locked in. This isn't speculative buying. This is industrial necessity.
Manufacturers like Tesla, BYD, and Ford aren't buying silver because they think the price might go up. They're buying it because if they don't have it, the assembly lines stop. This creates a fascinating yet terrifying paradigm shift. For the first time in history, we're seeing consumption-driven scarcity. In the past, silver prices moved based on whether investors were scared of inflation. Now, the price is being anchored by the fact that we are literally burning through the above-ground supply. We are turning silver into industry products that are rarely recycled. Once a solar panel reaches the end of its life in 20 years, recovering that silver is expensive and difficult. We aren't just using silver, we are consuming it. Think about the scale of this. We are talking about hundreds of millions of ounces being permanently removed from the market and installed on rooftops and in car chassis. This is why that $72 mark on the COMEX floor we discussed earlier feels so different this time. It's not just traders clicking buttons, it's the physical world catching up to the paper market. So if the demand is this relentless and the green revolution is non-negotiable, why aren't the miners just digging more out of the ground? Why hasn't the supply side of the equation stepped up to meet this silver fever? To find that answer, we have to look past the shiny solar panels and into the dark, deep reality of the global mining industry. Because what the Silver Institute is reporting right now isn't just a dip in production, it's a full-blown structural deficit that has been 5 years in the making. And that brings us to the most alarming part of this puzzle, the breaking point of global supply. If the demand is this relentless, why don't we just dig more silver out of the ground? It sounds like a simple economic fix, but the reality is far more grim. According to the latest data from the Silver Institute, we are currently facing a structural deficit that has lasted for 5 consecutive years. We aren't just low on silver, we are consuming significantly more than the world's mines can produce. Think about that for a second. For half a decade, the world has been surviving on stockpiles. But those stockpiles aren't infinite. Why can't the mines keep up? Because silver is a byproduct metal. About 70% of the world's silver supply comes as a secondary result of mining for copper, lead, and zinc. This means even if the price of silver skyrockets to $100, a copper miner won't necessarily open a new mine just for a bit of extra silver. The supply is inelastic. It doesn't just snap to attention because the world is hungry for solar panels. But there's a new layer of complexity that the mainstream media rarely discusses: the Hormuz tax and the breakdown of global logistics. Silver isn't just sitting in a warehouse in your backyard. It has to be moved. It has to be shipped through some of the most volatile maritime choke points on the planet. When geopolitical tensions flare up in the Strait of Hormuz or the Red Sea, insurance premiums for cargo ships don't just go up, they explode. We call this the Hormuz tax. This hidden cost is being baked into the spot price you see on your screen. It's not just about the value of the metal, it's about the massive cost and risk of getting that metal from a mine in Mexico or Peru to a factory in East Asia. Every time a drone flies over a shipping lane, the cost of stabilizing that $72 floor becomes more expensive. We're looking at a perfect storm. On one side, you have a mining industry that physically cannot accelerate fast enough to meet the 5-year deficit. On the other, you have a global supply chain that is becoming increasingly fractured and expensive. When you combine a 5-year supply deficit with rising Hormuz tax logistics costs, you start to realize why that $72 price point on the COMEX isn't a ceiling, it's a pressure cooker. The Silver Institute's warnings are clear. The buffer is gone. The safety net of global silver reserves has been shredded. This is exactly why the smart money is no longer playing the same game as the retail traders. While the public is watching for a $2 dip to buy in, the world's largest hedge funds and institutional players are looking at something else entirely. They aren't just looking at the mines or the ships, they're looking at the Federal Reserve and the net long positions that are being quietly stacked behind the scenes. If the physical supply is breaking, who is controlling the digital price? And, more importantly, what happens to that $72 floor when the biggest whales in the ocean decide it's time to move? To understand that, we need to dive into the net long positions of the market's true masters. While the physical supply is reaching a breaking point, something even more fascinating is happening in the digital shadows of the paper market. To see where the price is really headed, we have to look at the COT report, the commitment of traders from the CME group. This is the ultimate cheat sheet that reveals what the biggest whales in the ocean are actually doing with their money. And right now, the data is screaming. Managed money, the elite hedge funds and institutional giants have been aggressively stacking net long positions.
In plain English, the smartest money on the planet is betting heavily that the price of silver is going up. They aren't just dipping their toes in, they are diving headfirst into the deep end. But why now? Why are they so confident in this $72 to $73 range? It's because they are looking at a macro-perfect storm. The first factor is the DXY, the US dollar index. For months, the dollar has been the king of the mountain, keeping a heavy lid on precious metals. But as the global economy starts to shift, we're seeing cracks in that strength. The dollar is cooling off, and in the world of commodities, when the dollar breathes out, silver breathes in. The second, and perhaps most explosive factor, is the Federal Reserve. The market is no longer asking if the Fed will cut interest rates, but when. As we move deeper into 2026, the consensus for a pivot is growing. Silver, like gold, is a non-yielding asset. It doesn't pay you a dividend or interest. So when interest rates are high, silver feels heavy. But the moment the Fed signals a cut, that weight vanishes. This is the springboard effect. The hedge funds see it coming. They are positioning themselves now so they aren't left behind when the floodgates open. They are looking past the current $72 stabilization and setting their sights firmly on the $75 psychological barrier. Think about the logic here. We have a 5-year physical supply deficit on one side and a massive tidal wave of institutional long positions on the other. This isn't just a coincidence, it's a convergence. The physical reality of empty warehouses is finally meeting the financial reality of a weakening dollar. When these two forces collide, the current volatility range we've been tracking on the COMEX will look like a flat line. The big players aren't worried about a $1 drop today because they are bracing for a $10 surge tomorrow. They are using the current price floor as a massive accumulation zone, absorbing every ounce of silver that panicky retail sellers are willing to let go of. The question isn't whether $72 is too high. The question is, what happens when the paper market realizes there isn't enough physical metal to settle the massive long bets being placed right now? We are moving toward a moment of truth, a moment where the industrial hunger we talked about meets the financial greed of the world's largest funds. And when that happens, the price of silver won't just move, it will redefine what we thought was possible for a utility metal. But what does all of this mean for you? Are we standing at the edge of a golden age for silver, or is there one final trap waiting for the unwary? Let's bring this all together. So where does all of this leave us? We've looked at the $72 floor on the COMEX, the industrial hunger for the green revolution, the 5-year supply deficit, and the massive net long bets being placed by the world's elite funds. The picture is becoming undeniably clear. Silver is no longer just gold's little brother or a simple safe haven asset to hide in during a storm. We are witnessing the transformation of silver into a strategic industrial necessity. In a world that demands more solar energy, more electric vehicles, and more high-tech infrastructure, silver isn't a luxury, it's the foundation. The stabilization we see at $72 and $73 isn't the end of a rally, it's the quiet construction of a new launch pad. We are moving into an era where the physical reality of empty vaults is finally going to collide with the digital promises of the paper market. History shows us that when supply can no longer meet a mandatory industrial demand, the price correction isn't gradual, it's explosive. We've seen it with lithium, we've seen it with cobalt, and now the stage is set for silver. Whether you're a trader looking at the COT reports or a long-term investor eyeing the macro cycle, the message is the same. The buffer is gone, the Hormuz tax is rising, and the demand is non-negotiable. But as always, the most important question is the one I have for you. We are standing at a historic crossroads for this metal. Do you think this supply-demand crunch is finally going to be the catalyst that pushes silver beyond all previous forecasts in 2026? Or do you think the paper market still has one more trick up its sleeve to keep the lid on? I want to hear your take. What is your price prediction for the end of the year? Drop your number and your why in the comments below. Let's get a real debate going. If you found this deep dive valuable, make sure to hit that like button and subscribe for more technical analysis that cuts through the noise. I'll see you in the next one.